a struggling video game store went from $17.25 a share to over $500 in less than a month. Not a typo. That's GameStop, January 2021, and the buyers doing it were retail investors coordinating from a Reddit forum built for stock market jokes up against some of Wall Street's biggest short sellers. Then, right as they were winning, the app they used to buy the stock quietly switched off the buy button. Not the stock, just the button. Who actually came out ahead when the rules changed mid-game is the harder question, and it takes the rest of this to answer. Headlines called it a folk hero's revenge, David finally landing one on Goliath. Except revenge stories are supposed to end when David wins, and this one kept going long after the punch landed. Somewhere between the cheering and the collapse, the people losing money got a say in how the fight ended. Figuring out how means starting years earlier with a company everyone had already written off. GameStop sold physical discs in malls for a console business the internet had already made irrelevant. Streaming killed video rental. Downloads were killing GameStop the same way, just slower. To Wall Street's professional pessimists, that made it the perfect short. A business with a visible expiration date, bleeding sales every quarter, propped up by nostalgia and foot traffic nobody needed anymore. Betting against a company like that isn't recklessness. It's supposed to be the safest trade on the board. One guy on Reddit disagreed loudly under the name Deep Fucking Value. Keith Gill wasn't a hedge fund manager or a hotshot analyst. He was a financial marketer with a webcam, a cat-themed headband, and spreadsheets deep enough to make actual analysts nervous. His pitch was simple. GameStop's cash and inventory made it worth more than the market thought. He backed it by posting his own growing position month after month, like a receipt. He never told anyone to buy anything, he'd later insist. Thousands bought anyway. What made that bet risky wasn't Gill's spreadsheet, it was who he was betting against. Hedge funds and short sellers had piled in so aggressively that more shares were promised back to lenders than actually existed to give back. Normal math tops out at 100. Wall Street had found a way past it, which meant every share Gill and his followers bought wasn't just a bet on the company, it was a shove against a wall already leaning. The wall didn't just lean. Thousands of accounts started shoving at once. All pointed the same direction, all reading the same spreadsheets on a forum famous for self-inflicted losses. Or Wall Street bets turned a value thesis into something closer to a flash mob with brokerage accounts. No hedge fund whale placed one gigantic order to spike the price. Instead, it was a swarm, thousands of small ordinary buys hitting the market at the same moment. Wall Street had models for whales. Nobody had built one for a crowd that doesn't get margin calls. The swarm kept buying, and the price kept climbing in jumps that looked less like a chart and more like a fever. Each jump was good news for Gill's crowd and very bad news for the other side. Get a long bet wrong and you lose everything you put in. A bad day, capped. A short has no ceiling, no floor, no natural stopping point at all. The price can keep rising forever, and so technically can the bill. The bill came due fast. Every short seller staring at that bottomless loss had exactly one way out: buy the stock back immediately to close the bet before it got worse. So they did, which meant the very people trying to escape the squeeze were now feeding it, driving the price up further and triggering the next round of covering right behind them. It was a feedback loop with no operator. Among the hedge funds exposed to the squeeze was Citadel, according to reports, the fund empire built by billionaire Kenneth Griffin. By the morning of January 28th, that loop had done what feedback loops do. It fed. That opening scene peak wasn't hyperbole. For a few hours, this dying mall retailer was worth more per share than most of the actual blue chips sitting in the S&P 500. The shorts caught inside were bleeding by the billion, Citadel among them. The guy with the spreadsheet had somehow out-leveraged the people who invented leverage. You could still hit sell. That part never stopped working. It was buy that vanished, for GameStop and for a handful of other stocks riding the same wave, which meant retail traders could only ever move the price one direction from here on out, down. Robinhood pointed to its clearinghouse, insisting it simply couldn't post enough collateral to guarantee the trades. Maybe. But Citadel, Griffin's hedge fund, hemorrhaging billions on this exact trade, also owned Citadel Securities, the market maker processing a serious slice of Robinhood's order flow. Funny how the one door still open led exactly where the short sellers needed everyone to walk. The backlash didn't wait for an explanation. Within hours, politicians who couldn't agree on a lunch order were united on this. Lawmakers from both parties, including members of Congress, called for investigations into the trading restrictions imposed during the GameStop volatility. Regulators got flooded with complaints. Cable news booked the same guest on 3 networks by dinner. Because when the far left and the far right both smell a rigged game, that's not politics anymore. That's just math everyone can read. The frenzy didn't fade because the crowd got bored or the thesis stopped making sense. It fizzled the second the button did. With buying gone, the only trades left moving the price were sells, and short sellers finally had what they'd been begging for all week: room to buy back their positions quietly without another wave of retail money shoving the price higher behind them. The stock cooled off. Retail didn't walk away from the fight, though. It got benched, and the bench, it turns out, is where the real story kept moving. Keith Gill's identity became public during the GameStop events, leading to significant media attention on the retail investor behind the movement. Unmasked the same morning, his followers lost the ability to hit buy. The timing landed like a warning shot. Within days, dozens of class action lawsuits piled onto Robinhood. When it finally reached Congress, Gill didn't hide behind a screen name. Keith Gill testified before Congress regarding his involvement and role in the GameStop movement. Nobody in that hearing room proved otherwise, so if posting numbers on Reddit wasn't manipulation, somebody still owes an answer for the app that stopped working the one morning it mattered. The hearing wrapped, the headlines moved on, and every instinct said this was over. It wasn't. On February 24th, GameStop's price doubled inside 90 minutes. No new spreadsheet, no fresh testimony, just a stock, apparently unaware it was supposed to be finished. It didn't snap back down afterward either. The freeze had only stopped the buying button, never the believers, who kept holding, kept posting, kept refusing to let the story end on Robinhood's terms. GameStop still had to be a company, though, and companies do quarterly earnings whether the internet has feelings about them or not. No conspiracy needed this time, no brokerage villain, no clearinghouse excuse. Just a retailer with real numbers, reminding everyone, chanting its ticker, that underneath the movement was still a business. And businesses, annoyingly, still have to file paperwork. The bruise didn't last. No new filing, No fresh spreadsheet from Gil, no headline anyone could point to and say, "There, that's why." Analysts who'd spent a career explaining price moves with news had nothing to attach this one to. The company hadn't changed. The math hadn't changed. Something else was setting the price now, something closer to a crowd's temperature than a balance sheet. GameStop had stopped trading like a stock and started trading like a mood swing with a ticker symbol. Griffin's fund recovered, and he's since been reported worth tens of billions. Gil never fully sold either. He just kept holding quietly, like a man who'd already read the ending. Neither side, strictly speaking, lost, but neither side clearly won. And the one question everyone wanted answered, why the collateral ran short that exact morning for that exact stock, still hasn't gotten a real answer from Robinhood or anyone with the authority to make one stick. Which is, in its own way, the answer. Next time, what payment for order flow actually buys.